for that. Yeah, I mean, big gains yesterday, starting about 1.5% higher this morning as well. Now, Karan Taurani is Senior Vice President, Research Analyst at Elara Securities. He's joining us now to discuss what's going on. Some of these new age companies, lock-ins are expiring, pre-IPO investors are getting out, and others are getting in. Old blood going out, fresh blood coming in. Karan, hi, good morning. Your broad assessment of how things have sort of happened so far. Deepan was with us earlier, who was saying that, well, some of the supply has been pretty well absorbed. Your thoughts, initial first take.
Hi, Prashant. Thanks. Good morning. So basically, if you look at what is happening right now, this was more on expected lines. Clearly, you will see a shift in terms of the nature of investors in these internet companies. Now, there'll be some companies which will be standing out within the bucket, and there'll be some companies, which may not be. And the reasons for that is, the path to profitability. I think for any internet company, you have to showcase a path to profitability. Otherwise the valuations, may not be justified. So when these IPOs had come in last year, most of them were given a valuation of, basis EV sales, because there was no metric to measure the EBITDA or the PAT margin. But definitely there was an expectation that, margin will come in and there will be profit, which is there. So wherever there is a clear path that, there is some sort of a reduction in terms of losses, there is some sort of improvement in terms of showcasing some kind of a margin, the companies are getting a premium valuation. Wherever that visibility is not there, the valuations have, just come down sharply. So I think this is how it's going to be. I think the internet play is going to be more selective in nature, and profit focus is something, which is going to continue, because I think institutional investors would not continue to value companies on an EV sales basis.
Hi, Karan. Good morning. What kind of multiple are you giving these companies? If you could give us a sense on them.
So I think if you look at these internet companies, what we are doing is, we are trying to kind of benchmark this to the traditional companies. Now, for example, like a Zomato, we are trying to benchmark this to Jubilant. For a Nykaa, we're trying to benchmark it to, traditional FMCG personal care companies. So in terms of, growth rates, obviously these internet companies, in terms of revenue growth rates, are towards, 25 to 40% in that wide range. Depends on basically which category they are playing at. And the traditional companies in the same bucket are not growing more than 10 to 12% in terms of revenue. So definitely that premium is justified. But we also what looking at is in terms of the margin as well. So if you look at something like a Nykaa, their BPC core BPC margins would be in the range of about 10 odd percent in terms of EBITDA, as compared to other personal care companies, which would be close to 20-25%. Similar to a Zomato, I think currently, they have kind of, increased their margin in the last 3 quarters with a clear focus, by cutting down on marketing spend, some rationalization on employee front. So they are, trending more towards that, 4 to 5% kind of an EBITDA margin guidance, which is there. So I think what we're trying to do is that whichever company is, kind of able to garner a better EBITDA margin with hefty growth, the premiums are going to be higher versus the traditional counterparts which are there. So I think this is the only way we can kind of mirror it as of now. And if you even look at in terms of the PE basis as well, there will be a similar kind of premium just as on the EV EBITDA front.
So what do you do from here on in stocks like Nykaa, delivery, etc.? What is your advice?
So on Nykaa, basically, we have a buy rating. Okay. Our target price on Nykaa is 240 rupees post this recent bonus announcement, which is there. We believe that, the competitive intensity in Nykaa definitely is growing in terms of online BPC space. But again, it's not very easy to replicate what Nykaa has done in terms of first move advantage, in terms of customer experience, in terms of the trustworthiness, because a lot of the products that are sold on Nykaa are premium in nature. So, customers don't really want discounts, but they really want the premium product, and they want the genuineness of the product, basically. So that's one in terms of the growth rates for the PPC. And, there are also multiple margin levers, from lower fulfillment costs. We are going to see higher ad revenue and also some increased share in terms of private labels. I think basis these, 3-4 things, I think there is good enough leeway and room here for the revenue growth to be about 25 to 30 odd percent for the next 3 years. With a consistent improvement in terms of margin. The only monitorable or the risk factor for Nykaa would be, the fashion business, because we're not very confident of, them doing something very well over there in terms of profitability. They are still making losses. I think that segment is highly competitive, too much of discounting. So I think that's the only monitorable in terms of, where the fashion losses actually come down, or probably that business goes to break even. As far as Zomato is concerned, I think we've all seen that, last quarter we saw what happened there in terms of growth. The growth has, come down severely from a 35 to 40% kind of a range towards a 25-30% kind of a range. But I think that's not bad if the company is trying to focus in terms of margin. If there's a clear trajectory that the margins will, kind of move up from here on. But Zomato, from a business standpoint perspective, we believe the concerns are multifold. I think the first thing is the issue of take rates, wherein we've seen, constant pressure from NRAI, CCI kind of authorities, kind of wanting to reduce the take rates. Then there's the issue of order value in India. So if you look at India for that matter, once you increase the frequency in terms of delivery, it's very tough for order values to actually move up. And effectively, delivery charges may not also move up because they are linked to the order value. So I think there are concerns, in terms of the profitability path for Zomato. But nonetheless, if they're able to surprise positively, I think that stock could also see some sort of a re-rating. And the multiple in terms of losses would be the Blinkit business, the quick commerce one, which is again highly fragmented. Unit economics still not proven on a larger scale per se. And we clearly don't know in terms of what is going to be the intention and how far they're going to go, in that business. So I think Zomato is more of an uncertain situation right now in terms of profitability. Nykaa that way has got a more proven business model as far as profits are concerned.
All right, fair enough. Thanks very much, Karan. Appreciate you joining in. Right here in the studio, we have both Zomato and Nykaa users, right?